All right, guys. Welcome to another edition of the Investment Committee webinar. Appreciate you joining us today. As always, we want to give you guys a market update, look at how the market's been doing both year to date and in the last month. We have some interesting news stories for you that we think have been shaping what's happening in markets right now. We also have a nice chart for you at the end that will tie things up nicely. So looking at the market vitals so far this year, the S&P 500 has had a pretty strong start to the year, up almost 11%. And in the last month, up about 2%. If we look at some of the other major indices here in the top right of this page, we can see the NASDAQ 100, which is very technology heavy, is up almost 18% year to date. And some of these other major indices, the Russell 2000, which is focused more so on small cap companies, which have struggled in the last few years. In 2026, that index is up almost 22%. And the Vanguard Total International Stock Index has also performed pretty well, up almost 15% year to date. So we can see that S&P 500 has had a great start to the year, but some of these other major indices have done even better when we're looking at technology, small caps, international. So there's been a lot of great places in the market to be invested so far this year. What have we seen so far, Brandon, in terms of some of the different sectors in 2026 and over the last month?
Yeah, I think, this is an interesting table to look at. When we've had these webinars previously, usually we saw the energy and technology sectors at the top of the list from a 1-month performance of how they've done. But over the past month, we've seen more defensive sectors like healthcare, financials, and utilities, do better than them and outperform. One of the things with, energy over the last month is the Iran and US, ceasefire talks. So that's kind of brought oil down to $70 to $80. But as you're still looking at it at the whole year to date, what's been driving it? It's still, technology being up 27%. And even if you're looking at healthcare and financials, their year to date performance are 5.5% and 3.4%. But you can see before the last month, they would have been negative, but over the last month, they'd done 6.3 and 7.7. So kind of just something interesting to look at as, what's been going on in the past month, but then also as a bigger picture, what's been going on the last 6 months in the market.
Yep. And just looking at that Bitcoin number, I mean, that's something that is jumping off the page a little bit year to date, down almost 28%. We saw that above 100,000 in 2025. And so far this year, it just has not done very well. I think part of that is there's just been more exciting places in the market to be invested with some of these semiconductor, artificial intelligence companies that have seen a lot of inflows. Bitcoin has not been on that list of things that are seeing rising prices this year. And if you look at money market rates, at Charles Schwab, money markets are paying about 3.5%, 3.49%. That's something that will move with interest rates. So if we see something like a rate hike, we would expect that money market rate to also rise. If there's something like a rate cut in the future, that would also fall. So something we just want to keep you guys in the loop about is what that money market rate is paying. And that is something that is in flux with interest rates.
We got to have semiconductors on here up 100% year to date.
Yeah.
I mean, that number's nuts. Also, I'm surprised the international stocks in the last month are up as much, knowing that the dollar's up about 1.5% during that same period. So if the dollar was neutral, that number is actually closer to like 5.5%.
Yeah, that's a great point. Yeah, I mean, we can see here on this page, this is just a continuation of some of those market vitals. That US dollar so far year to date up almost 3% after we saw last year was down about 10%. So that has been coming back a little bit. We look at 10-year treasury rates. That has gone up to about 4.5% currently. At the start of 2026, that was 4.1%. So that's led to a little bit of struggling in the fixed income market. On the first page, we have the Barclays Aggregate Bond Index, and that was up less than 1% so far in 2026. So that 10-year treasury rate being up explains some of that weakness in fixed income. But if we just look at some of the economic data that we've had recently, CPI for May, which was the last reading, was 4.2%, and the core CPI was 2.9%. So when you look at that 4.2%, that's incorporating things like oil. The US-Iran conflict has had a large say in that CPI number being so high, 4.2% being way above the 2% target that the Federal Reserve has had. But another factor that's impacting it is chip demand, really impacting inflation numbers. And we saw that with Apple recently raising their prices on iPads, MacBooks, and they cited that chip demand and the lack of supply in chips as part of the reason why they're raising their prices. So that's one of the factors that's in that core CPI number of 2.9% that isn't necessarily related to the US and Iran conflict. And other economic data, growth and job markets have remained pretty solid. GDP is looking like it's going to grow a little over 2% annually, looking at that final Q1 number. And unemployment stayed relatively low at about 4.2%. So all in all, economy is looking pretty strong. Inflation has ticked a bit higher with oil and some of the chip demand. And that's part of the reason we've seen that shift from potential rate cut coming into 2026 to now, if we look at this chart here, year end, there's an 86% probability that there's going to be a raise in rates by the end of the year. So some of that economic data gives the background as to why that shift has happened so far in 2026. Anything you guys would add there?
Yeah, I mean, I think just looking at, the interest rates and how different of a story it is that we talked about at the beginning of the year on these webinars and also in the news of how there was potential rate cuts, but how quickly the data can change, especially with what's going, just on in the world in general. If inflation ticks up or there's other economic data that comes in, it can kind of change the narrative. So even while we have, these probabilities right now for what could happen during the next meeting, which is July, but then also through year end, it's kind of, like it says, it's a probability that could happen, and it could, continue to change too based off of, other things that are happening months from now that, we're not predicting or anything like that. So just always something to note too of, at the start of the year, we thought, hey, there could be potential rate cuts. And now 6 months in, the story's kind of flopped on the other side. So always something just to kind of look at and take note of too, of how it, can change throughout the year.
I think those changes though, we can't talk about the Fed and not talk about Kevin Warsh. That guy came in hot. Yeah, that was almost like a speech after an MMA fight. The press conference. It was just, it was almost surreal and very different from, the Janet Yellen and Ben Bernanke's and, these very kind of stringent academic style economists. This guy came in all game show and, very assertive. So I think the market's trying to figure out what he's about because, he's appointed by Trump. Trump spent the last, year and a half complaining about interest rates being so high. And then Kevin actually came in and was surprisingly true to his regular colors, but his behavior was unusual. And also they got rid of their forward guidance. What is going on? They got rid of their forward guidance. I think that's such a big deal. It was swept, just under nothing. So for those who are listening, don't, if you don't follow the Federal Reserve's, post meeting summaries that they give, they basically copy and paste the same thing and they'll change one or two words. And there are guys who will read this and they'll highlight the word changes and then they'll send it out as a post oh, look, they said from moderately to slightly. And what does that mean? And, there's all this building into it. It used to be about 300 plus words. The last one that was released is Kevin Warsh's first Fed statement release. It was 130 words. So we basically just cut it in half. That is so normally a Fed chair change is kind of ooh, what's he going to do? How's it going to change? What's going to be different, right? We're looking for cues. This guy basically came in and just took the whole table and flipped it over and said now what? I don't understand the strategy there. And his whole argument for not having guidance was to allow the market to be more pure in its adoption of economic information. What? It's such strange behavior. It's really it's mind-boggling. So as we look at this, I would say that this is going to be a fast-moving diagram right here that we have of what people's expectations are and what the Fed's going to do and not do, because I think there's a little bit of shell shock right now of how Warsh kind of came in and made some very quick, unprecedented changes in a very dramatic and disruptive fashion. Is that fair to say?
Yeah, absolutely. I think it definitely becomes harder to judge what the future looks like when the Fed itself is getting rid of that forward guidance. So it's tougher to tell what's in their minds and how they're thinking about the future when they're no longer providing that to the public. So,
I mean, it's really just turned them into a bit of a wild card. And that used to be kind of a place of stability and a place of where, and I'm not saying that I think the entire culture is flipped and changed just with the Fed chair. He is just the chair. It's kind of like the mayor, or the speaker of the House. They don't really dictate much except agenda and kind of like who's on committees. And so I don't think he can't just turn the whole thing upside down in one swipe. But, we've kind of seen some institutions change with their leadership and kind of what their policies and core values are. And I think that, if you were to sit around with some real old school Wall Street guys, they're a little unnerved by kind of what they've seen happening with the president trying to influence interest rate policies over the last year and a half. And then Kevin Warsh comes in and kind of does all of this. And it's just, if you watch this space very closely, you're feeling uncomfortable about what's going on over there. And I think that's just worth kind of throwing out there. I know I threw way more words than I need to add it, but that's me.
No, that's good color for sure. In addition to the economic data, that has been a big change in the Fed department. So it's good to keep an eye on that.
Turns out wars lead to inflation.
Yeah. All right, looking at some of the recent news stories, divergence in the AI trade. So looking a little bit closer at semiconductors, which has been a big story so far this year, versus hyperscalers. They're kind of two different ends of that artificial intelligence trade. So although artificial intelligence as a total has gotten a lot of hype, we've seen semiconductors do extremely well, as Jordan mentioned, up over 100% on the year. And just looking at June in a silo, up another 11%. And that has been pretty well deserved, looking at the numbers that they've put up in terms of revenue growth, profit margins, that semiconductor chip space and really the infrastructure around artificial intelligence has deservedly done very well in terms of the profits and revenue. But while you look at the other side, like some of the hyperscalers in the Mag 7, and just for clarity, a hyperscaler is a large technology company that owns and operates data centers, providing cloud computing services at an enormous scale. So think of companies like Amazon, Google, Microsoft, these companies that are really building these AI ecosystems within their companies. They have faced a little bit more scrutiny around things like return on investment and monetization. So while semiconductors are doing extremely well, making sales, improving their revenue, some of these larger Mag 7 companies that are investing a ton into artificial intelligence to buy these chips and build these data centers, they haven't seen as much of the return on investment and profitability yet. And so investors are looking at that and saying, all right, what is this return on investment going to look like in the future? And it's a bit harder to judge that hyperscaler player versus the semiconductor player, which is actually making sales and generating revenue today. So there's been a real difference in that real demand for chips and infrastructure versus that skepticism around how the AI ecosystems are going to monetize and get that return on investment. So that's been an interesting dichotomy to see so far this year. Is not every artificial intelligence company or company that's related to AI is doing equally as well. We've seen a little bit of a divergence between hardware and infrastructure and some of those bigger players like Amazon, Microsoft, Google. Anything you guys would add to that story?
Yeah. And I think like Sean, like that's the point right there is even as you're looking at headline news, it's still AI is the frontline words that you're going to see on the headlines. But if you go under the hood, not everyone's being rewarded the same for their, role in it, whether you're the one selling the chip or building the data centers or using, cloud computing. So as you go through those stories, you're like really recognizing who are the players in that and, how have they done over this year or even the past 3 years too, where, the trend is being a little bit different of, who is doing what now with AI. It's not just AI in general.
Yeah, great. It's a great point, Brandon. And the biggest kind of headline that we had around this space last month was SpaceX's IPO in June. It made history in being the biggest IPO that we've had so far. It also was the first to enter the NASDAQ under the new fast track entry rule. So it was able to do it much shorter than just a couple of months. That officially happened yesterday. So now any regular investor can participate in investing in SpaceX. And then there's also the SK Hynix, South Korean AI memory chip maker, making an IPO on Friday. And it also is priced out, implying that it's going to be over $1 trillion valuation. So together, these two IPOs are really just highlighting how this 2026 AI concentration, is really kind of a key thing.
Well, one thing, as I've been, writing the monthly commentary and kind of getting a little bit deep in it, I found a really interesting paper from Goldman Sachs where they talked about all the investment, the capital investment that the hyperscalers are doing. And using that, I kind of said, all right, well, let's assume the payoff is in 10 years. Because right now they expect it to be somewhere, the most optimistic would say 3 years. I would say the more pessimistic side says 7 years. And that's kind of the shelf life of some of these AI chips and silicon is about 7 years. But I just gave kind of a 10-year number. And I asked, and calculated what a 5% return on investment is, a 10% return on investment, and a 15% return on investment. And a 15% return on investment, which I think is really, if this is going to be considered a win, you kind of need a 15 ROI, I think, to really, hold your head high and say this was money well spent. So that turns out to be on a cumulative average. If we look at it, it's about 9.9 trillion cumulative. So that's about a third of the current sized economy. If the economy keeps growing at its pace, it'll be about 45 trillion in 10 years. And that means that AI, the return on these investments would have to be earning at a run rate of about $2.5 trillion per year. So what does that mean? That means that all the money that these hyperscalers are throwing into AI, for this to be considered a win, in 10 years, this thing needs to be producing revenue for them of about $2.5 trillion across kind of the board, which turns out to be somewhere around 5% of the economy. Now, when you put it into that perspective, like you can take a step back and say, okay, 10 years from now, is 5% of the entire economy potentially going to be AI? I feel like it's going to be more. So I think there's a lot of skepticism here. And when we look at just the size of the numbers and the money they're able to create right now, which obviously isn't great compared to the cost and the CapEx, but that's why they have huge cash on their balance sheet. So I do appreciate and give a huge hat tip to the whole concept that, maybe this is an AI bubble and maybe they're overspending, and Meta just announced that they're going to have to rent their compute or they're considering renting their compute. I'm sorry, let me rephrase that. They're considering it, but kind of testing the market to see how it responds to the idea of them renting compute, i.e. admitting to overbuilding. And you're kind of seeing, some of these things here, but I think if these companies are probably, because these projects take multiple years to kind of get going, I think they've stretched their vision plan out a little bit. And I think it would help investors to stretch their vision plan out a little bit. I know that's tough when semiconductors make 100% in 6 months. But if we kind of go 10 years out and say, what's this really going to look like? I don't think any of this investment looks silly. And that wasn't so true during the tech bubble. And that's another thing that we always get compared to. They spent a ton of money putting fiber optic cable into the ground that doesn't have the same value today as it did. And I'm sure this compute that they're building right now will become obsolete in the future as well. But I don't think that return on investment is going to look at such a sunk cost, because they're also training models on it now. They may decide to run slower and older models that do more kind of, rudimentary functions on kind of old software. Like Google had a 5-year shelf life for some of its storage and processors, but they repurposed them for simpler programming, and their depreciation cycle went from 5 years to 10 years. Because Google said, we can actually use these, we can repurpose these. And I think that these companies are going to get better at that. I'm a little bullish on these companies with these supply constraints, and Apple saying, oh, we got to raise prices because we can't get enough compute. That's not going to solve anytime soon. Like the solution to that isn't around the corner unless they come up with some smarter way to use the compute. And I'm betting on these guys that they will. So I don't think that people should read into all the Michael Burry craziness, the AI bubble too hard without stretching that vision plane and seeing a little bit of like, where, can this go? It's likely to be a bumpy ride, but I think if you really sit back and kind of think about how much of the economy in 10 years might be driven by AI and how much revenue that might drive, I think it's going to be more than 5%. I'd be willing to bet on that.
Yeah. Agreed. I think it's easy for investors to just see semiconductors and see the revenue growth and the profit growth and say, oh, that's where I want to be right now. But I think, like you said, looking at the future and the potential for some of these hyperscalers, the future could end up being pretty bright for them. And like you said, 5% of the economy for AI in 10 years seems like I would take the higher end of that too.
It's just amazing when you see some of these companies, the profit they're making and like, their performance, and then analysts are just like throwing them under the bus like they don't know how to allocate capital. And I agree, it's kind of like a nuclear arms race right now. And during arms races, people tend to, stop calculating, very carefully, and it becomes emotional. But I don't know, man. It's very hard for me to see AI's use case becoming less in the future. And I think only about 6% of its use function in corporate America has been deemed productive and accretive. So it's only a 6% useful thing. How much time do CEOs spend talking about it? They know that statistic, but they know that statistic's in its infancy. What if it goes to 20 or 30% effectiveness of use? It's going to be nuts. So, all right, I'll get off my soapbox. Let's keep going. By the way, if anyone on the call who's joined us, any of the participants have any questions or want to raise something, please throw it in the chat. This is a juicy topic.
Yeah. And so for this chart, we just have the performance from the start of the year until the end of June of the S&P 500, which is down about 0.7%. The Mag 7, which is about flat, and then the rest of the S&P, so the S&P 493, which is up about 15.1%. And I think this goes back to Sean's news story of what's driving the market and the differences between the hyperscalers and then also the semiconductors. You can see that the Mag 7 is basically flat on the year, where in the past 3 years they were such driving factors in the market. But, we're seeing the semiconductor index being up, to your point, like 100%. And even if you go back to the first slide, over the past month, where you're starting to see a big divergence here between the three graphs, you're starting to see other sectors in the market too start to outperform and do well over a near-term period. So it's just always something to take interesting of, okay, here's how the Mag 7 is doing and all these incredibly big technology companies, but how's the rest of the market doing too? And looking at that, and then also looking at, years past too, when they were such driving factors of it, versus you are starting to see this divergent, especially in the past, month during this time.
Yeah. It is wild to see how quickly that divergence can happen. Like if you look back in May 2026, you can see that the Mag 7 was outperforming the S&P and the S&P 493. and you fast forward a month and a half, and now the Mag 7 is underperforming the 493 by almost 16%. So that just shows how quickly the market can change these days. And that, like you said, semiconductors have been a big part of that 493 having such an explosive last couple of months.
Yeah. Or even like within the Mag 7, you're kind of seeing a divergence too of, how they're performing this year with, like Google and Apple are still up, over 10%, but then you also have like Microsoft and Tesla, which are down over 10% this year too. And then, like NVIDIA's up like 4 or 5%. So,
which is crazy, by the way.
Yeah.
Yeah. I mean, it just hasn't seen the same movement as a lot of those other semis.
I also think they got a little bit of a stigma with the OpenAI deal and the fact that they're kind of look like they're, investing and then paying themselves with the investment dollars for it just didn't feel great, I think, for a lot of investors. And I don't think there's anything nefarious about it. And Jensen Huang probably is the smartest CEO in the semiconductor space, but I think that's an opportunity. But
yeah. I mean, we also have the next year or so. We got SpaceX just IPO'd 15 days ago, as Luch was mentioning. Anthropic, OpenAI potentially IPOing in the next 6 months to a year. So how does that impact the Mag 7? Does that become the Mag 10? Is there some new name that tracks all of these AI?
I think we just change it to the Avengers and move right on, dude.
Yeah, that's good marketing.
I'm with it.
It's going to be interesting. And I think also, when you get these companies which are relatively young and the market's not that familiar with, I think, one thing for the Mag 7, not that it's like watching an old sports team or something, but it's getting kind of old seeing the same names all the time. And you start to just think, oh, they just have a monopoly on what they're doing. But there's some really new, exciting companies. And when Google burst on the scene, I want to say it was, back in the middle 2000s, it was like this kind of new unheard of, oh yeah, have you tried this new search thing? I think it's Google or something like that. Like nobody really knew about it. And suddenly it burst on the scene, and now it's, one of the most dominant companies in the world. And, Anthropic, which I think is still not a household name. If you told someone like, hey, what does Anthropic do? Maybe, 30% of the population might associate it with Claude. I think that's, a company when you listen to their executives speak and you hear them talk about their product and what they're trying to do and what they're trying to accomplish, I get major early Google vibes from them. They just really feel like, they took what everyone else was doing. It's not like Google was the first search engine, and they just kind of approached it a little bit differently and a little bit, in a way that just felt good, character good. Google used to say we're a good company as one of, their taglines. And it seems that Anthropic's trying to kind of walk in that, in that space. They've come out and they've been very public about kind of slowing down the AI race. And if you just read the headline, you start to think like they're whining. But when they talked about it a little bit more, I'd watched I think a TED Talk or something with one of the executives kind of responding to it. And they were like, no, we did that because we know that how disruptive this is going to be to like the world, and the governments aren't ready. Like they have not set themselves up to deal with the job shifts that are going to happen. And, just kind of what's going to need to occur to kind of make way for this new intelligence, which is kind of coming in. It's another interesting thing. This isn't technology. This is intelligence. And I hadn't really thought about it that way, but, it made me kind of sit and ponder for a minute. When we think about technology revolutions, and here we have an intelligence revolution, and someone was, kind of kicking the tires on that and the exponential growth that we're going to see that we're really not used to.
Yeah.
It's going to be an interesting time. And I do think that companies are something that you have to kind of get yourself educated around if you're an investor, if you're at home doing this by yourself, or even if you're, just someone kind of watching from the sidelines and interested. I think it's a good time to kind of get familiar with some of the names which might be, the future leaders of the economy and innovation.
Yeah, even if you look 5 to 10 years ago, it was all about the FANG stocks. Now it's Mag 7. So FANG used to be Facebook, Apple, Amazon, Netflix, Google, and now NVIDIA's in there, Tesla's in there. So you look 5 years from today, and what is that new top 10 stocks that are being tracked? What does that look like? So it's interesting to see the evolution of that.
What was the international were the granolas, right?
Oh, granolas, yeah.
Yeah.
To give them too.
Good for an acronym. Good for an acronym.
Yeah. All right. Well, that's all we got for you guys today. Appreciate you hopping on. It's been a exciting last month in the markets, an exciting 2026 so far. If you're hopping on and joining us for webinars and you want to see more content, we started a recent video series on our Instagram called After the Bell, where we post updates every day on what's happening in the markets, what the narratives are, what some of the performance is looking like for that day. So feel free to tune into our Instagram there to get daily updates if monthly just isn't enough for you. But thanks for joining us, everyone. Appreciate you guys. And we'll see you next month for our next webinar.